Welcome back to our exciting journey through the world of financial modeling. In this second part, we will demystify financial statements and equip you with the knowledge to interpret them effectively for modeling purposes. So let's jump right in. Financial statements are the backbone of financial modeling. They provide a snapshot of companies' financial performance, position, and cash flow. Understanding these statements is essential for building accurate and insightful financial models. There are three main types of financial statements: the income statement, like here you can see the balance sheet, and the cash flow statement. It looks like this. It generally contains these components. Let's start with the income statement. The income statement, also known as profit and loss statement, presents a company's revenues, expenses. Here you can see revenues, expenses, and the resulting income over a specific period. It helps us understand the company's profitability and assess its ability to generate profits. Next, we have the balance sheet, which provides a snapshot of company's financial position at a specific point in time. It presents the company's assets, liability, and shareholders' equity. And there is a universal equation for balance sheet, like asset is equal to liabilities plus shareholders' equity. The balance sheet reflects what a company owns, its assets, what it owes, its liabilities, and what remains for the owners, like shareholders' equity. It helps us assess the company's financial health and solvency. Finally, we have cash flow statement, which shows the inflows and outflows of cash during a specific period. It provides insights into companies' operating activities, investing activities, and financing activities. The cash flow statement allows us to evaluate the company's ability to generate cash, manage liquidity, and understand the sources and uses of cash within the business. Usually, these are the metrics in a cash flow statement. Now that we have covered the basics of each financial statement, it's important to understand how these statements interrelate. The three financial statements are interconnected, and changes in one statement impacts the other. For example, like you can see here, we have a Microsoft financial statements. Here it's income statement, net income from continuing operations, and here we have a balance sheet. Here these are the retained earnings. The profit after tax or the net income from income statement flows into balance sheet, and it comes to retained earnings in the shareholders equity section. And similarly, from cash flow statement, the free cash flow comes to balance sheet. Here under the assets, in current assets, it comes to cash and cash equivalents. So the financial statements are interlinked to each other. To effectively interpret financial statements for modeling purposes, we need to analyze the key components within each statement. These include revenues, expenses, assets, liabilities, equity, and cash flow. When building financial models, we use these components to create formulas and assumptions that drive our projections. It's crucial to understand the relationship between these components and their impact on the overall financial health of a company. Now let's make the learning experience interactive. I'm going to ask you a question and I want you to think about the answer. Okay, let's say, what are some key items you would look for on the income statement, balance sheet, or cash flow statement to assess a company's financial performance and stability? So take a moment to think about it and feel free to share your answers in the comment section below. We will discuss this further in our next video.